So options. Here's the 4 basic positions that you can do with an option contract. Quite simply, you can, every single option strategy that's out there comes from these 4 different trades. You can buy a call. You buy that call, you're considered long, and that means that you have a right to buy the underlying stock at a specified price. You can buy a put, and puts are always confusing because if you buy, it means sell. It means you have the right to sell the underlying at a specified price for a limited time period. On the other side of the coin, we are looking also at sellers. Once you sell a call or a put, you are considered short that position, and you are actually referred to as the underwriter of the contract. Usually we shorten that in the options trading world, and we talk about it being the writer. And I'm going to talk a little bit about that when we get into the example using an insurance contract. And then the thing about a seller is that you take on an obligation. You get paid premium, then you have an obligation. If it's a call option, you're going to have an obligation to sell. One way to think about this and where the term call comes from is people can call stock away from you because you take on that obligation. So the term call actually comes from the seller side of things, not from the buyer side of things. Also, when you talk about the put side, if I am the seller of a put, I take on an obligation to buy. So in that instance, I am once again taking on an obligation for somebody to put stock to me, and that's really where that term comes from. So we're going to focus on puts today because we're talking about pricing, and that's the origin of the options trading market. That they were really meant to be insurance products to protect an underlying asset, not tools to speculate. And that's fairly important that you understand that basic concept when you are trying to figure out or get your hands around how an option pricing contract is calculated, why the value is what the value is. All right, so to do that, I'm going to do the most simple example. Most people out there own a car most people that are watching this, not everybody, but most people that are watching this probably have purchased car insurance at one point in time in their life. And it's real interesting to see the synergies between a car insurance contract and an option contract. Now, once again, I'm going to focus on puts because of what I mentioned, and that we're going to think about this as an insurance contract. So the strategy I want you to have in your head as we go through these variables is the protected put strategy. Say we own 100 shares of stock is trading at 90, we buy an 85 strike put. That means that if the stock, our 100 shares that we own at 90 goes down below 85, we can take the stock take our stock that we own and put it to somebody at $85. That's a protected put. It's limiting our downside, but we still own the stock and we have unlimited upside. That's the short of a protected put. So if you're thinking about that type of option contract, and you're thinking about trying to price it, let's go over to the insurance world and let's think about the price of the asset. Let's think about our car insurance that we're talking about. Is the asset a Ford Taurus, or are we talking about a Bentley? Right? There's a difference between the 2 different vehicles. It's going to cost you more to insure the Bentley than the Ford Taurus just because of pure costs. Now, in the stock trading world, there's also a much difference in cost between different underlyings. Are you buying an asset, or are you trading it on a stock that is a $100 stock, or are you talking about a $10 stock? There's a much difference in the price of the asset just because of the underlying price of the stock. So if the stock's at 100, guess what? It can go from 100 to 0. If the stock's at 10, it can only go from 10 to 0. That's 10 points versus 100 points. And that is going to be reflective in the price of the option contract. Deductible. Car insurance, very rarely do you buy the 0 deductible car insurance. Why? Because if I buy the 0 deductible car insurance, it's usually quite pricey. So you usually say, I want the $500 deductible or maybe the $1,000 deductible. And we can handle that in the option contract and the put example that we talked about, the protected put, by the strike price. We talked about a stock being at 90 and you buy an 85 strike put. Well, guess what? You're buying the $500 deductible on your 100 shares of stock. From 90 down to 85, you have that risk, and then from 85 on down, you can grab that stock that you own and put it to somebody at 85. So in that world, that would be the $5 deductible or $500 deductible insurance contract. Now, time is money, as Mama always said, time is money. The longer, a 6-month policy is going to cost you less than a 1-year policy on your car insurance. Plethora of different expirations in this day and age on option contracts. But bottom line is, time costs money. The further you go out, the more and more expensive that your option contract is going to be. And then next up, we have carry costs. And a lot of people don't think about carry costs when they're buying car insurance or even an option contract. But when do you pay for your car insurance? Usually you pay before they insure your car, right? You don't pay after the policy. That means that the insurance company gets money up front. And the concept in the insurance world is that if they make a very good interest rate or good money over the life of the policy, then you're supposed to get a discount on your next 6-month policy. That's what the concept would be in a utopian world, but we don't really know that that's the case. But they get your money up front and hold it over the life of the policy, and that means that they're earning interest on it, and that does get factored into the price of your car insurance. And in the options trading world, you have interest rates, but stocks also pay dividends, right? So you don't drive your Ford Taurus around for a quarter and they say, well, thank you for driving our car wrong, we're going to give you some money for doing that. But in the stock trading world, that's possible. So yes, you pay for your option contract up front. So the owner of the contract, the seller of the option contract, I should say, receives interest over the life of that option contract. And also if a stock pays dividends, that affects the price of the option contract. So this is one huge package that we got to think about when we're pricing an option contract.